A very good afternoon, ladies and gentlemen, and a warm welcome to this Personal Investing 101 webinar series brought to you by Allan Gray. Now, this is a series of conversations where we aim to keep you informed, to leave you feeling a lot more inspired and seeking the knowledge that you require in order to provide you with the fortitude to embark on your journey to long-term investing success. My name is Gugulethu Mfuphi, and it's my pleasure to be the host of this webinar today. And if it's your first time joining us, where have you been? Today marks the final edition of our season finale of these webinars that we've brought, ranging topics and conversations that we've uncovered. Everything from understanding the need from investing, the different role of investment accounts that one can make use of, and of course, even monitoring your own behavior, your relationship with your financial advisor and planner, and understanding how various investment funds play different roles in terms of your investment journey. So it's been quite a whirlwind, but today we wrap it up by actually reaching out to you, giving you a clear reminder of this investment journey and the philosophy behind Allan Gray, and most importantly, understanding and unpacking some of your burning questions. So do participate with us today, where we welcome you to share any of your questions, as basic or as complex as they might be. Together with the Allan Gray team and our panelists joining us today, we'll endeavor to adequately respond to your questions. And should they be more personalized as well as structured to maybe your own personal needs, we will ensure that an Allan Gray consultant will be able to reach out to you and offer you a bespoke service in terms of sharing and understanding with you. Well, we're quite excited to have you today, and as mentioned, this is the last edition of our webinar series, but we promise that we won't leave you lacking in terms of the knowledge that you seek. I'd like to start off by introducing my panelists who will join us in responding to a variety of questions that we'll share, and most importantly, questions that you will also be allowed to actually ask during the conduct of this particular webinar. Let me start off by introducing our first three speakers. Gladness Rupare, she's the Manco specialist at Allan Gray. Mthobisi Mthimkhulu, who's the manager of private clients at Allan Gray, followed by Nomi, Bodlani, head of strategic markets at Allan Gray. Now, before we do commence with our conversation, I do want to politely remind you of the fact that Allan Gray is not authorized to offer any financial advice. However, should you seek the services of a financial advisor, we can share contact details as to how you can evaluate and identify one within the industry. Most importantly, all information that's provided in this webinar and in previous webinars is intended to fully capacitate you with the knowledge that you seek in order to be a successful long-term investor. Well, we've made it quite nicely into the new year. Many of us have a spring and a jump in our step because we're optimistic about what 2021 brings, but we're also mindful of the learnings that we had to experience in 2020. And that even brings us down to technology before we touch on investments. If at any time during the webinar you happen to lose connectivity, we do ask that you do your very best to try to reconnect and, most importantly, rejoin the meeting by following the help prompts followed by Zoom. If not, do double check with your connectivity or even your load shedding schedule, just to make sure that you are fully connected to join our conversation. Well, without further ado, I'd like us to get into the conversation today. And as mentioned, we are slightly more optimistic about the year ahead, but we also cautious about how optimistic. Given that we've stepped out of a global healthcare pandemic, which has had significant economic ramifications, we are well aware of the meltdown that we experienced in the markets just over a year ago. But Gladness, I'm hoping that you can hold our hands and guide us in this conversation by allaying some of the fears and concerns that some of us might have. That given the fact that we've experienced and seen an economic meltdown, we're hearing in the news headlines that markets might be picking up. But for anyone who is keen to invest right now, how sure can we be that we'll reap future benefits of our investments, given that there's no calling when this pandemic will end?
Thank you, Gugu, and good afternoon to everyone online. Gugu, I think, we're all looking for that green shoot, that light at the end of the 2020 tunnel. And there's a lot of expectation, like you rightfully said, on 2021, where we are going to see some kind of recovery. But I think the reality of the matter is that we actually don't know, when the pandemic is going to end and really what the ultimate outcome is going to be. So it makes it very tricky. But what we do know is that, the market is cyclical, which means it moves in cycles. And those cycles are really driven by investor sentiment and human emotion, etc., etc. So it's quite hard to keep tabs of that. So for instance, when investors are feeling positive, the market moves in a certain direction. When investors are feeling fearful, the market moves in another direction. So it's quite hard and very unpredictable. So I guess to answer the question regarding reaping the rewards, I think it's good to start with to look at the performance of last year. So I have a slide that I want to share with you so we can have a look at how that all played out. All right, so this slide really looks at the performance of our local equities. So it's the all share index performance, and we've taken it back to 2019. So if you cast your eye on 2019 through to December 2019, you can see there are a few bumps here and there, but it wasn't a volatile year. January 2020, we started off quite okay, but then of course, like you rightfully mentioned, Gugu, we experienced that sharp decline in our market. What's interesting, however, is if you fast forward to where we are now, or even December 2020, you can see that we are at pre-COVID levels, which is quite interesting. One, I'm actually surprised that, after a decline of 30%, the market has gone on to recover. And it's hard to believe that the all share delivered 7% for 2020. This is a lesson in long-term investing. So Google, if you decided in March of last year and you invested 100% in the all share index, and you decided at the bottom that, the pain was too much for you, you want to disinvest, the world is coming to an end, you would have missed out on that opportunity to recover. And you'd have locked in those losses. So important to note that it's vital to stick to your goal, to stick to your investment objective. And if that hasn't changed, so your investment strategy shouldn't change as well. So time in the market, I'm sure we've said this over and over again, trumps timing the market. Like I said, it's quite difficult to predict the market. So consistency is key, and conviction, and staying invested. Asset managers like ourselves are not exempt from the consistency equation. We need to also be consistent in the way we say we manage money on behalf of our clients. So if Allan Gray is value-oriented, we need to ensure that the investment philosophy is consistently applied. And I'm very proud to say that our investment philosophy has been consistently applied through various market cycles for the past 46 years. And that is just because mainly because we're privately owned, and that means that we don't have outside shareholders who put pressure on us to change the way we invest. So we believe, Gugu, that's ultimately our competitive advantage.
You're quite right, and I'm glad that you touch on the investment philosophy, because it almost seems as though that's your plan, that's your vision, that's your guide, that even when the markets experience tumultuous times, you remain consistent according to that plan. Gladness, I'm intrigued because this clearly shows us what Allan Gray, or what the market performance rather, has been for equities in South Africa. But tell us about other asset classes that Allan Gray might actually invest in.
Okay, before I touch on the asset classes, very important for us to understand the blueprint, like you say, our investment philosophy. So investment philosophy is a value-oriented approach. So what does that ultimately mean? We look for assets that are trading at a discount to what they're actually worth. So think of it as, you're house hunting, you're looking for that house that is in a good neighborhood, it's safe, there's good schools, you know that you're going to get this house, this house is going to appreciate in value, and you know that you're going to get it below the asking price. So that's the way you can actually think of us, that we're looking for good quality discounts. So then the question is, what kind of assets do we then invest in? Do we invest in? And this slide really shows and encompasses that. So we have highlighted the assets from low risk, high risk that Allan Gray invests in, starting with cash at the bottom and then equity right at the top. So what I'm going to do here is just give you a high level description of these various asset classes. So cash is an easy one. An example of cash is deposit with the bank, and the prevailing interest rate right now is plus minus 4%. So if you had to put your money in the bank, you would be getting around about 4%. The next asset class that I want to talk about The next asset class I want to talk about is bonds, and bonds is a debt. A bond is a debt instrument. What that basically means is it simply means the issuer promises the holder a fixed stream of income over a specified period. So now you might ask, who is the issuer, who's the holder, etc. So it's almost like a company taking out a loan, right? The company is the issuer and promises the holder, who is Allan Gray, on behalf of clients, a fixed stream of income over a specified period. So important to note that an issuer doesn't have to be a company or corporate. You have government issuing bonds, you have parastatals issuing bonds, etc., etc. So a bond is a debt instrument. Property is a tangible asset or real estate. What that basically means is that at Allan Gray, we don't actually, own actual buildings, or we're not invested in the bricks and mortar, but rather we gain access to the returns generated by these buildings through listed property shares on the JSE. So that's property. And then lastly, we have equity, and it's ownership of shares in a company. That's quite self-explanatory. An example of the shares that we have would be the likes of Standard Bank, Old Mutual, Naspers, etc. So this really just gives you an overview of the types of assets. When we talk about our investment philosophy and we say we're looking for good quality assets that are trading at a discount to intrinsic value, that investment philosophy is applied throughout all the asset classes. And really now the question is, okay, so how does this translate into an investment account? How does it translate into a unit trust? And how do you then know which unit trust to select and which unit trust is appropriate for your needs? And I think that's the next segment that Mthobisi is going to touch on. And with that being said, I'm going to hand back over to you, Gugu.
Thank you so much for that, Gladness, really giving us some insight into the various risky asset classes, but of course, understanding that risk is personalized. And speaking of this personalized investment journey, with Mthobisi, we're keen to hear from you as to what are the considerations then that one needs to keep in mind when they want to begin this investment journey.
Sawubona Gugu, and everyone who's listening at home. Just listening to Gladness as she goes through the different asset classes, there was a part of me that gets excited. Every time I meet someone who says, where should I be starting? Or as I'm thinking about their investments, and my response is always start with yourself. And I'm sure to many, I'm starting to sound like a broken record. But if I were to really speak to the factors that one must consider when they're thinking about their investments, I've got a nice slide that I just want to share that speaks to these elements or these factors. And I think the first one is what we call accessibility factor, and which really speaks to when are you going to need or use your money. And I think this is so important when it comes to investing, because having this conversation with yourself allows you to get a clearer idea in terms of what you are investing for. Right. So if you are investing to renovate your house in 5 years' time, so now based on that, that's when you will need to access your funds in 5 years' time when that project needs to start. But what's nice about having this conversation with yourself is that then it allows you to think about the time that you have for that investment, which speaks to the second part, which is the time factor that one needs to consider. So that really speaks to how much time do you have for this investment. When it comes to investing, time is everything. I think this is a part where we can have a webinar just talking about time, the importance of time when it comes to investing. And maybe perhaps that's my unofficial lobby to say let's not end this series. But that being said, when you're thinking about time, having enough time in an investment allows you to think differently about your investment decision. And it also allows you to think of risk differently, which is another factor the next factor that one needs to consider. At Allan Gray, when we think about risk, we think of it as the probability of losing your money. But when it comes to investing in the different asset classes, having enough time allows you to invest your money in higher risk asset classes that Gladness spoke to. Let's say now, because you have 5 years, that means then you can consider investing maybe a larger portion of your money in shares which are higher risk asset classes. And that also speaks to the last factor that I'm going to speak to, which is the return factor, in terms of how much return are you looking to get out of your investment. When you have enough time, then you are able to be patient, allow your money to compound over time, and also being able and considering that you're investing in higher risk assets.
You raise a very critical theme there, which is, of course, taking it back to a personalized approach. And speaking of personalized, that's exactly why we're having this webinar here today, where we're answering questions and going to share more feedback with many of our guests who have joined us online. And that takes me back to the fact that we've asked you to share your questions here today. We have prompted you to get in touch, and I see that there's a hive of activity in the question and answer section. But there's one more caveat that we want to share with you, and that's the fact that you have to upvote the questions that you want to have answered first. So if you take a look at the Q&A section, click a thumbs up on the question that you would like to have answered first, and we'll continue to allocate questions that might be super personalized to an Allan Gray advisor or consultant to be able to assist you with many of your questions. And looking at some of the questions that have come through, Mthobisi, not prompting you on any, but I think it goes back to the question following the personalized approach, understanding what your goals are, what risk is, and understanding how long you have to invest. The big question is, how do I find the right unit trust that's appropriate to my needs? Can you give us a guideline on that?
Gladly, and maybe going back to my slides, I also have a nice slide that speaks to this. You know, and a personal approach for me, I say there are many ways, obviously, of investing and many approaches. I've always felt the personal one is the best, you know, because it allows you to be clear on your own objectives so that you are only investing in things that speak to that. You know, we live in a country where there's so much choice. In the last webinar, we spoke about the number of funds of unit trust that are available in South Africa, you know, with over 1,500. And that can be overwhelming to many individuals. And then finding the one that is best for your investment goal becomes a bit trickier. So let's say you have started with yourself, you are clear on your goals, you want to invest. I'm going to go back to that example of renovating my house in 5 years' time. And now I'm looking for a unit trust. Now, when it comes to the funds that are available, what you often find is that these funds are categorized into three. You have funds that are known as low-risk unit trust funds. You know, you've got medium-risk unit trust funds as well as high-risk unit trust funds. And what you find that the risk level that's allocated to a fund really speaks to the asset classes that the fund is invested in. So an example, a low-risk unit trust fund will be invested or will have a bigger portion of its assets invested in what is known as low-risk assets. And as per Gladness slides that she shared with us, that fund will mainly be invested in cash. Whereas on the other hand, a higher risk unit trust will likely be invested in the higher risk assets like shares. And what's nice on my slide that you're looking at the moment in the center is got this where you can see in red, it shows that a higher risk unit trust is designed mainly for an individual who's looking for long-term prospects. So this is someone who has enough time. And at Allan Gray, we usually say long-term, you're looking at about 5 years or longer. Whereas on the lower risk unit trust or solutions, those are designed for someone who's really looking for capital preservation. So for me, when you are clear as an individual in terms of your goal and you know what you are investing for, it becomes a lot easier when you're looking at the funds that are available. An example at Allan Gray, someone who's looking to invest for a low risk or short-term investment, that person could invest in what we call our money market fund that only invest in cash. Whereas for my plan as an example, because I want to invest for 5 years or longer, so perhaps I could allocate that money in our equity fund.
I'm reminded following having seen this screen, the fact that in previous webinars, we actually touched on the fact that it's easier to understand which product to invest in and how long for if you're able to name your investment objective. So if you're looking to change your tires in the next 6 months, you'll be able to figure out just how long it is that you need to keep that money invested for. If you're looking to save for your child's education or even a deposit to purchase a property, all of those make it easier then for you to kind of understand the not only investment goal, but which particular fund and account might speak to your investment needs. Again, a reminder for you to upvote your questions by clicking on the thumbs up button. I see there's quite a bit of activity and we'll get into those questions in just a moment. But let's tell the truth. The discipline that's required when it comes to investing is not always so easy to endure. Many a times we find ourselves getting tempted or shortchanged and we actually decide, I don't think I'll stick it out with this investment or I'll start over at another time. And Nomi, this brings me to you. Previously, we've discussed how our behavior can influence our investment outcomes, but give us a reminder as to why sometimes just staying committed and sticking to our investment objectives just remains so difficult for some individuals.
Thank you, Gugu. I think you actually mentioned the first kind of situation that can make it difficult for us to really commit to long-term investing. And that's really if we don't actually understand the role that investing can play in our lives. And so if you think about some of the kind of your biggest life goals, we find that investing can actually help you with those. So, something like having an emergency fund means being resilient when you have unexpected setbacks, saving for a financially independent retirement. That's another really important goal. And then thirdly, you might have things that you want to invest in the future that maybe require a large capital expense, which is the kind of thing you might not be able to fund from your salary. And so I think the first one is just really understanding how investing can play a role in helping you achieve some of the things that you want to achieve in life. And then the second one's got to do with the fact that it is actually really hard for us as humans to prioritize future needs and wants against our present needs and wants. And so you actually have to be very deliberate to take a step back and figure out what it is you need in the short, medium, and long term, and make sure that, how you spend your money, how you split up your budget and commit to investing is consistent with what you want to see in your life over different periods of time. If you're interested in a bit of psychology, scientists say that our brains actually value immediate rewards. So this idea around instant gratification is something quite innate to humans. And so it means that, when we take actions now, our brain values getting immediate benefits from those actions. And so long-term goals means that we have to take actions now, but we're not actually getting an immediate benefit. And that can be quite hard. And so I think it takes the hard work to take a step back and think deliberately about what it is you want in your life, not only now, what you need to achieve and the needs and wants you must meet now, but what about the medium term and what about the long term as well?
That's a very important point there, and I guess it echoes the sentiments that Mthobisi shared about it being a very personalized approach, because our goals differ, our ambitions differ, our life's journeys differ, and sometimes that might mean that our investment strategies will also differ. Something else that differs quite a lot, Nomi, is our investment behavior, which I understand. As you say, some of us want the quick fix as well as feeling the instant rewards of gratification. And some of us are a little bit more patient and able to ride out the long-term volatility that was experienced in the markets, as highlighted by Gladness earlier. Give us a guide as to what are some of the emotions that drive this behavior.
Sure. So I think the emotions part is such a key one, because if we're not conscious of it, we may find ourselves making decisions that actually hurt our investment outcomes. And so typically what we see happen is Gladness earlier was speaking about the fluctuation in the market. And what happens is that if you're exposed to the market, so if you invested in, for example, an equity fund, which is 100% exposed to stocks on the JSE, it means that, as the underlying shares fluctuate, it means that your investment value is also going to fluctuate. Now, this can be really scary. And one of the things we see is that if you look on the image on the left, is that when things are looking good in a fund, investors, they want some of that. And so they buy into the fund or they invest into the fund. And so you put your money into the fund. But, as things fluctuate, there will be times when that performance is negative, and this can be scary. And this will make you feel very scared. And so what happens is when the investment value drops, we are filled with fear. We're worried. Is it going to drop further? Is it going to recover? And so we might take an action to then sell out of that fund and move into something that's a little bit more stable or a lot more stable, like the money market fund. And so we kind of see this cycle pan out quite often, in fact. And the result of that is that you're not actually able to, particularly if you move out of funds in times, for instance, when performance is poor, it means that you're not invested in that fund when performance recovers, and you miss out on that recovery. And history has shown that the best trading days often happen after periods of poor performance. And so there's a high likelihood you're going to miss some recovery. If you look at what Gladness was speaking about earlier, how in March we had this decline or drawdown of like minus 30%. And so if you moved out at that time, you would have missed the recovery that came after that. And the impact of that is that, the investment return, if you look at the image on the right, is that the investment return that the fund or, whatever it is that we kind of invested in, or it could be the all share in Gladness's example, that investment return is actually higher than the return you have. And the reason that is because you weren't actually invested for the full period of time. And so we call that the behavior gap, essentially. And so what that means is our emotions can lead us to act or take decisions on our investments that can actually lead to poor outcomes for us. And so it's very important that our not only having a goal, but we have a strategy that's going to help us take a step back when we need to, in order to evaluate what decisions we need to be making when it comes to our investments.
That's quite important. We know that sometimes emotions drive us to do crazy things, but playing with our money is not exactly what we're trying to do. And of course, the elaboration of the behavior makes complete sense if we try to reflect on how it is that we even manage our own personal finances on a day-to-day basis. But when it comes to this journey of investing, Nomi, Gladness has highlighted the markets and how, whilst we can't control the markets, what we can control is our own behavior and sticking to our own objectives. What are the elements that we need to be mindful of then to position ourselves for long-term investment success?
Sure, I actually put them down just to give you almost like a quick checklist that you can use. So, assuming that you are invested and you've actually gotten started, and now it's really about what can you do to position yourself for success and making sure you have a strategy to help you remain committed to your investment goal. And so the first one is just, whenever you find yourself in a situation where you are, you feel like you have to make a decision on your investments, whether it's to move out or move in, just make sure you're taking stock of where you are. What are you feeling? Is there anything that's scaring you? Is there anything that's pressurizing you or making you think you need to invest in a particular stock, or rather in a particular fund? So just take stock of where you are emotionally, and then also do a reality check. So, focus on the truth. So Gladness explained earlier how that markets are, they fluctuate, and that, your investment manager might have a particular philosophy, and that might mean that it means there will be times when performance is, in the short term looks poor or has declined. And so it's important that you understand investment truths. And then the third one is to really focus on what you can control. I think, making decisions on your investments are not, you shouldn't see it as an emergency. So give time and space to those decisions, review your goals, and as I said, prioritize across different horizons. It's not just about what you're feeling now, but you may be scared, but your retirement goal hasn't changed. And so it's important that you remain committed to that goal. So constantly review your goals across the time horizons to make sure that you do remain committed. And then very lastly, just connecting to perspectives and advice. So friends and family can help you, but also, don't be afraid to seek professional advice. A financial advisor is not only going to help you, focus on what you can control, help you understand investment truths, but they're actually going to be someone who can hold you accountable and almost give you direction and say, actually, this is what I believe you can do. And that can be really comforting to have the professional services of someone who's an expert at financial planning actually guide you on what to do.
Thanks for that, Nomi. I think that provides a lot more clarity. A lot of us are quite eager and excited. As I mentioned, it is the beginning of a new year, and there must be a lot of optimism as to how best then do we stay committed to our investment goals and objectives. And for those of you who have been shy, maybe confused, or just lacking in some of the understanding of how the investment world works, we're going to make things a lot easier for you, as within the chat and Q&A service, we'll be sharing a link with you as to how best you can get started. And this will take you through all the concepts that we've discussed, not only in today's conversation, but in previous webinars as well, where you understand your own personalized investment goals and objectives, understand the risk that you're trying to are able to take on, and most importantly, the length of your investment journey to understand which appropriate investment account will help you achieve your investment goals. Well, we're quite excited. Again, a reminder that that link, Getting Started, is a tool, goes straight to the Allan Gray website and will give you a guide and step-by-step understanding as to how you can embark on your investment journey. A reminder that we are going to take your questions in just a moment, and quite excited that many of you have been sharing some of your questions. And again, a reminder that you can upvote those questions by clicking on the like button or the thumbs up button, which essentially will ensure that we address the questions that each of you want us to address most urgently so. A reminder as well that if you do ask any specific questions that are rather personalized, we will ensure that one of our Allan Gray consultants will reach out to you and be able to share some perspective in terms of managing your bespoke questions and offering you solutions in that manner. Well, I think we've set the tone, and I'm quite excited for us to get started in conversation and understand where it is that we can go from here. We've shared the Getting Started tool with our audience, and of course, we're quite keen and eager as well to hear from our audience what follow-up questions they also might have. And maybe that takes us to the theme, Mthobisi, coming back to you in terms of if somebody does go to this Getting Started tool, a guideline perhaps as to how to navigate that particular landscape and key questions that they also need to ask themselves as they walk through the Getting Started tool, just before we get to some of the audience questions.
So the Getting Started tool is, as you've kind of touched on, is a really nice tool that allows you to kind of like put help you in a way, guide you to that decision to choosing the investment account that you'll invest in, as well as the funds that you'll invest in. So in fact, my colleagues have shared it on the chat tool, so that's something that we can all access. I was wondering if there was a way for me to even maybe perhaps go to it and maybe share with those, so those that are in attendance can actually see how it looks like. I just want to click on it. But the nice thing about the tool, it asks you how much you want to invest and how much are you contributing to your investment. And then with that, it gives you that opportunity to select a fund that you can use as an example to see how would your investment performed had you had invested in the last, let's say, 5 years to the investment, and kind of give you an idea in terms of how your investment would have grown over that period of time. And then at the end of that journey, it takes you nicely to our Invest Now tool on our website, when you can complete your investment, starting by choosing your investment account, which we spoke about in episode 3 of the series. And then from there, then you can select the fund that you wish to use.
Well, quite excited and seeing some of the feedback that we'll hear from that, and of course understanding that as audience members you are able to embark on that journey by yourself. But you might also recall that in previous webinars we've also discussed the relationship of a certified financial planner and how they also assist in your journey with your investment manager and understanding your investment funds. Maybe, Mthobisi, just a quick refresher for people to know how to identify a certified financial planner, or if they're able to embark on the journey alone. But what key fundamentals do they need to be mindful of if they're taking on someone who is an expert and who can coach them and teach them versus embarking on the investment journey alone?
You know, and I've sat down with many clients helping them start their investments, and you speak of that part, the need for coaching. You know, and when it comes to investing, let's say you are investing in an asset class, years you've decided that you want to invest for 5 years, and over time that investment may underperform or go through whatever cycles that the market might be going through, and you find that many investors then they panic. You know, and a statement I've heard too much is I'm cutting my losses, you know, and many people often choose or decide to sell their investment for less than what they paid for. Essentially, that's how you lose money when it comes to investing. And for me, looking at that whole process, and that's often when I've seen that's when a financial planner comes in very handy. You know, someone maybe perhaps who has a broader understanding of the industry and who's kind of seen markets perform in similar manner over a period of time, they can provide that guidance. But the whole topic of selecting a financial advisor for me often starts with finding someone that you can trust, and when it comes to your finances, that person becomes key in helping you succeed. Someone that you trust, someone who has your best interest at heart, someone, and I often go and say, this is someone that you are also paying, so this is someone who needs to be capable. In South Africa, many financial planners are required to be certified financial planners, meaning that these are individuals who are educated in the field of financial planning, and they've written a board exam, so they become part of the Financial Planning Institute. So this is a body that also requires them over a period of time, to maintain their knowledge and learning within the industry, so that they are able to provide or to assist their clients. So these are some of the things that I guess that are important for one to have in place. When I speak to my colleagues about finances, I always say that I come from a home where I have many siblings whom I love dearly, but I will not take financial advice from them because I know they do not have the skill or the expertise to help me in that regard. So it's important that it's someone that what they've got their expertise in that field, and I know this is not always easy as well, but if you can find someone maybe perhaps who has worked with that financial advisor, someone who can say, I dealt with this financial advisor and they were very helpful, and they were there, and I mentioned that part, Gugu, because we live in a country where often when you hear the word financial advisor, many people look away or they cringe because they've met many salespeople, who sell them a product and then they disappear. They call companies, where so and so, they are unable to find their financial planner. So these are some of the things, I guess, these are the realities that we live in. But I think it's important that you find someone who is credible, someone who has the technical know-how to assist you with your investment, and also someone that you trust. And that person can play a role in helping you stay the course when it comes to your investment. On our website, we actually have a tool which allows you to find a financial advisor. So when you go to our Invest Now tool that allows you to start the investment, at the very bottom of that page, you can find a link that will help you find a financial advisor. Depending on what you are looking for, then it will give you a list of financial advisors that are skilled in those fields. And then obviously you can do whatever due diligence that you need to do and reach out to them.
Thanks for that, and provides a lot more perspective that these are individuals who are just as highly qualified as any other professional would be. The same way you wouldn't go to court to represent yourself, the same way you wouldn't pull out your own teeth, but you'd rather go to a dentist, is the same way that you need someone to assist you and guide you with your investment journey by speaking to a certified financial planner who is also accredited. A reminder that that link is available in our chat for you to actually find an accredited advisor and work with them in embarking on your investment journey. Well, I see lots of voting has been taking place on some of your questions, and do keep them coming. For the moment, though, we are going to start with a question that has been submitted, and this one actually speaks to the investment arena globally. And I can imagine with all the companies we are exposed to, social media stocks, live television streaming stocks, and many other companies we're familiar with, there's a question here that asks, what are the benefits of investing offshore? And how do you access your funds that might be invested offshore should you have an emergency? Gladness, I'm assuming that you might be best positioned to answer this question. What are the benefits of investing offshore, and how do I access my funds invested offshore in the case of an emergency?
Perfect. Thanks, Gugu. In terms of why offshore and what the benefits are, I'm happy to answer that. And I think my colleague and Nomi, in terms of accessibility, I'll push that one through to you. So what is the benefit of investing offshore? So think of South Africa. In South Africa, in terms of the global capital markets, only forms 1%. Of the global capital market. So if you invested only in South Africa, it means you're missing out on 99% of other opportunities worldwide. So number one, it is for diversification. So it provides diversification to ensure that your eggs are not in one basket. So it spreads your portfolio so that your portfolio is positioned for various outcomes and is diversified in that regard. But that is basically why you would be looking to have a portion invested in offshore. I'll hand over to you, Nomi, to answer the accessibility question.
Sure, thank you, Gladness. And so, I mean, with different investment managers, you can open what's called an offshore account, and that will allow you to invest in offshore currency. So, at Allan Gray, you'd come, you give us your lump sum of 20,000 Rand, and we'd convert that into the currency of the relevant fund that you're investing in, and that allows you to access international funds. I think when it comes to emergencies, we need to make sure that whenever you have funds that are invested in a particular fund, you need to make sure that the fund objectives align with your own investment objectives for that money. And so typically for something like emergency, you're looking for something that will preserve your capital in the short term, and also something that you can access relatively quickly. And so typically people might not be saving offshore for emergencies. They might put their money in, say, a money market account. And so I think that's the important thing to realize about investing offshore. Some of the funds have some longer trading cycles, and so it might take a couple of weeks to get your money out and withdraw it. But yes, of course, you can withdraw your money, but you just need to be sure that the fund that you're investing in is a fund that aligns to the goal of serving the purposes of an emergency. Typically we find people invest offshore for very long-term with long-term return expectations. And so for more short-term emergency sort of needs, people often would invest in something like a money market, which allows you to preserve your capital, so there's no extensive fluctuation, as well as being able to access your money relatively quickly. So you just need to be conscious of that when investing for emergency purposes.
Thanks for highlighting that, Nomi. And I think it's a nice reminder to actually understand that investing is really a journey, a slight marathon with multiple stops. So depending on at which mark, you might need a water break at 5 kilometers, at 15, or even 21. Those are the elements in terms of understanding how it is to allocate some of your investments, by understanding how long or how quickly you might need access to your money too. And of course, by using the tools and the guidelines on the Getting Started tool to actually ensure that you're investing in the right investment account. We've got an interesting question that's been receiving quite a number of votes from our attendees, from Josh Dreyer. And this one asks, what is the difference between an ETF and mutual funds? Is a mutual fund the same as a unit trust? I'm not too sure if Mthobisi or Nomi, if you're keen to take this one.
Happy to start.
Sure, go ahead.
Sorry, Nomi. So the first part, a mutual fund and a unit trust are the same vehicle. In fact, that's the name that's mainly used in the Americas side, but it's essentially a similar solution. So the key part, I guess, I'll focus more on the difference between a unit trust and an ETF, or the exchange traded fund. A unit trust, which is what we offer as Allan Gray, and that's the solution that all our clients use on their investment, is essentially a solution that pulls monies from a number of investors, and then this money is allocated to an investment manager, in this case, which is Allan Gray for our case, who has the responsibility as per the mandate of this fund. So a fund is registered, and our job is to grow that money over a period of time on behalf of those investors that pull their monies together. And by doing that, as we have touched on earlier on in the webinar, is that we invest in a number of different asset classes, and using our style of investing, which is we buy companies that we believe are trading at a discount, and our goal is that we'll make or create wealth for our clients using that style over time. Whereas an exchange traded fund is also a similar solution, in that it's also a way of allowing investors access to markets, but using a different style of investing, where instead of having an active manager who's finding different assets to invest in, it actually tracks parts of the market. And there's so many. I think the one that's most common in South Africa is probably the top 40, which tracks all those companies. And what's special about it is that it trades in the JSE as well. So it is something that you can buy like a share, and by investing in it, obviously you get exposure to that part of the market. And obviously there are probably pros and cons for each one, but they've become very popular in South Africa, where we've got more people saying it's easier, through whatever platforms, they can access them and they can buy as they see fit. I'm not sure if Nomi, there is more that you would like to add.
I guess only that with what we call passive investing is that they typically often cheaper, the actual management or administration fees that you might pay. And then really kind of the difference being that, when you, as MT said, when you come to Allan Gray or another active investment manager, you're paying for their decision making on actively selecting each share, each asset, each stock that makes it into a particular fund, and making kind of the risk assessment on whether this particular stock makes sense for the objectives of the fund. Whereas when you're looking at a kind of passive investment instruments where they're tracking, a particular index, you're essentially getting whatever that particular index is getting. So there's less of active management on actually selecting which stocks and how do you actually put it together so that it achieves a particular mandate.
Thank you, Nomi and Mthobisi, for that. We alluded to the marathon earlier on, and Nomi, you did highlight the fact that investing is a long-term game. And what we've often witnessed in countries like South Africa is the fact that when approaching retirement, a lot of our parents or grandparents might find themselves a few rands short of maintaining the lifestyle that they're used to living for various reasons in not having adequate retirement savings. And this takes us to our next question that's been asked from our audience and also received quite a number of votes. The question asks, do you have products for or insight into how to accelerate retirement savings or create an annuity for parents who don't have retirement savings?
Sure, thank you. Sure, that's a really important question because it's something that is highly prevalent in South Africa. So we know that very few South Africans can actually retire financially independent. And secondly, we have what's called the sandwich generation, where a lot of us are actually supporting our parents, as well as our kids and maybe even people from our own generation. And so what that means is, we have this generation of people that are highly stretched in terms of supporting across generations. Having said that, I think the important thing to note is, yes, time is actually one of the most important levers when it comes to retirement savings, because if you start later, it essentially means that the proportion of your income that you put away towards your retirement increases quite a lot. So when you're in your 20s, that's, it could be less than 20%, but by the time you hit, your 40s, 50s, that's close to half your income you'd have to put away. So it does depend exactly when you're going to start making these retirement savings. I think it's important that you do the maths and just get a reality check to understand exactly what you have, where it will get you, what's the shortfall. And then being able to actually assess what does that mean, what does that mean you have to do. So it may be that there is a shortfall and you might need to support your parents for a particular period of time. It's something we see a lot in South Africa. And if you don't have time, I guess the important thing is to always start as soon as you can, but also to make sure that when you're investing in a particular fund, that fund is, the objective of the fund aligns to the time horizon that you have for saving. So do you have 5 years? Do you have 10 years? Do you have 20 years? So some of the money that you might be looking at preserving might be actually money that you'll need to support your parents in the short term. And so, you need to make sure you choose an appropriate fund, but you may also have, quite a bit of time because, when you retire, you don't need all the money right then and then. For, you live for another 30 or so years after you retire. So again, you do still have some time and figure out, how can you split your capital accordingly so you can invest for the time that you have and make provisions for where you have had to play catch up, whether it's the support that you have to provide and what that means for your own financial planning. And this is the sort of thing where it can be really helpful to sit with a financial advisor because they'll help you take in the scenarios. They'll be able to, figure out how much you will have in retirement, what the income will look like, what there's various products when it comes to retirement savings, but also kind of an ordinary unit trust, depending on the time horizons you're looking at. Might be suitable. So I guess the big takeaway is, yes, time is the most important thing, but just start as soon as you can. And number two, figure out exactly where you are and what you need to do to get to where you need to be for your parents' retirement. Even if there is a shortfall, then you need to figure out like how do you prepare for that shortfall, and a financial advisor, as I said, can help you with some of those calculations and figuring out exactly what you need to do. So you can have a once-off consult with a financial advisor. You don't have to like hire them for all of time, and that might be a good way to start.
Valid points there, Nomi, and thanks for instilling some confidence, because sometimes we get hit by anxiety thinking that it's too late to start investing. But as you say, understand your scenario and start where you are as soon as you can, but having a clearer understanding from experts as to how it is that you cover that shortfall. Gladness, we've kept you quiet for way too long, and I think there's quite a bit of excitement in terms of understanding how the markets work. But this one is also a question perhaps of concern, given that decline that we saw in March of 2020 when the markets really crashed. And the question is from an anonymous attendee, but received quite a number of votes. It asks, in terms of a worst case scenario, would a balanced equity fund ever go to a loss? And would I lose all of my investment?
So that's that's a question that we get from a lot of our clients, and it's investing is actually quite intimidating if you don't know whether you're going to get your money back. So the question is, if I give Allan Gray my money, am I going to get my money back first of all? So the example that you used is the balance fund, an equity fund, but I'll just stick to the equity fund because that's for your high risk. And basically what we're saying is that when we're looking to invest, and going back to investment philosophy, when we're looking to invest in these good quality assets, an equity fund, typically you need to invest for a minimum of 5 years. So that is long term. We've spoken a lot about long term and how it's important to stay invested. So you need to give the fund enough time to deliver on its objective. So like we showed that volatility last year, and the markets have periods of volatility, and they have periods where nothing much is really happening. And when you disinvest at a point where there's that dip like in March last year, you lock in those losses, and that basically means that you've lost, you might have lost some of the capital that you invested in. So to answer your question, the value of your investment can decline. And can possibly get to less than what you invested in. But again, going back to time invested in the market, give the fund the opportunity to deliver on its objective. And going back again to investor behavior, you need to be disciplined in your approach. And stick with that in the conviction, and stick to your goal. So if your goal was, in 5 years' time, this is what I want to do, stick to that particular time frame so that you don't experience these losses. So yes, loss is something that is inevitable if you do disinvest right at the bottom and you lock in your losses. But if you remain invested, then you're able to actually reap the rewards of staying invested.
Thanks for that, Gladness. We've got time for one more question, and I guess this one speaks to a sense of sitting in an investment, perhaps feeling dissatisfied with the level of performance and looking to switch between investment portfolios. And this one asks, I have a preservation fund, which I think is not growing. Looking at the time I started to now, therefore, I was thinking of cashing it out and starting an RA. Is this a great move investment-wise? Nomi, Mthobisi, as your brain cells get thinking away, feel free to share some feedback with us here.
Sure, I'll start and maybe MT can jump in. I think the really important thing about retirement savings is this: if you access it, what I'm assuming by cashing it out is that before retirement, you can get taxed. And so if you have a preservation fund, potentially it's the underlying assets, I imagine, that are not performing. And so this is kind of the decision that you need to take with a financial advisor, potentially around understanding the actual underlying assets in that particular fund. A preservation fund, as it says, typically it preserves your money for the purposes of retirement. And an RA allows you to do the same thing, but you are typically actively contributing to an RA. You can start an RA in addition to having your preservation fund. MT, I don't know if you have anything to add.
think the key part that you've already spoken to, Nomi, which is the product or the investment account, as we discussed in the last two webinars. That's not the part that grows your money. So it's the fund within that preservation fund that's probably underperforming. And obviously looking at, let's say if that person is thinking about starting an RA with Allan Gray, that means they'll also have access to the same funds, right? And I guess for me, when I had the question, I thought about someone, I guess, who's trying to sell their fund when it's lesser than the price they paid for it. You know, when I speak to clients and speaking about investing, I always say it's important to be clear on what is your investment. You know, as a client, you contribute a lump sum or a debit order on a monthly basis, but that money, once it's given to Allan Gray or it's included in your investment is no longer money, but it's the units that were allocated to you, which also speak to the question that Gladness answered. You know, those units that are allocated to you. So whenever you look at your statement or you are logging in on your online account, the number of units that were allocated to you, that is your investment. And obviously the price of those units will change daily. So maybe at the moment, the guest is looking at their investment, they see that the price of their units is less than the price they paid for them. Have they lost money? Of course not. They are not invested in money. They have their units and those have not changed. And the idea is, I guess, is that be patient enough for the price to recover so that should then in future they decide that they want to move to another unit trust fund, they can do so without locking in losses in their investments. In terms of the product themselves, they allow them more or less the same access.
Fantastic. I think we've really tried our best to answer as many questions as possible to ensure that everybody does feel a lot more informed and of course has the rigor to endure this journey of investment. One that can be incredibly rewarding as long as you follow through with the necessary guidelines and of course the concepts that have been shared here today. And I think just before we do wrap up, I'm quite tempted just to make sure that everybody does feel comfortable on this journey of investment where you might feel anxious, you might be nervous, you might not know if you have enough to invest. But Gladness, I'm going to throw this hot potato in your end as to what's the one misconception that you've heard about investing that you want to decipher here today. So if you had to sit around your friends, as we are doing here with our guests on our webinar, and they might be anxious, they might be fearful, they might be keen and eager and maybe decide to change their mind a week from now, what's the one thing that they need to be confident about in this investment game going forward?
Investing is for everyone, Gugu. There's this misconception that you need to have a lot of money to invest. But really, if you look at our minimums, 500 Rand a month. So that's one thing that, I would like to demystify and add on another thing that, there's a lot of people talking about investments and how, there's a lot of jargon that, we fail to understand. And investing is also quite simple at the end of the day. So anyone can invest and investing is simple to understand. That's my closing.
Thanks so much for that, Gladness. And for many of you who are still on the line, you can tell that in the chat, we've actually shared a link with you. That's our online, our Invest Now tool, which can be found but just by you clicking on that link, and it will take you through a process where you can get this journey started without having to delay. We've tried to ensure that you have all the necessary access to information that you require, answered many of your burning questions, and most importantly, do bear in mind that this is a journey that you can embark on not only alone and in partnership with Allan Gray, but of course by including a certified financial planner to assist you on your journey, because as we know, life happens, things change, and perhaps that might influence your own investment strategy and the goals that you'd like to attain. I am super excited that we've had the wonderful pleasure of engaging over the last 6 webinars to understand our personal investing journey 101 with Allan Gray. Unfortunately, it has come to an end, but we do want to strongly encourage you to make use of the tools and the links that we've shared with you to embark on your investment journey. And if at any point you find yourself falling short of some information that we might not have answered here today, please do feel free to go back to many of the webinars that we've hosted previously, just to give you better insight into how to embark and succeed in this long-term journey.